in the 21st century. Hard-working people working hard for you and me. Moving higher, time and time again. Through the years you'll find us here. Moving higher.
Hello and welcome to Moving Iron Podcast Markets with Shawn Hackett. This edition of the Moving Iron Podcast is brought to you by Dawsontire and Will, your premier ag tire and wheel provider in North America, helping people grow. Tractorzoom delivering insights, and Dryshod boots, the official work boot of the Moving Iron Podcast. Well, Shawn, how you been, man? It's been about a week, and I think we've re-entered the turbulence of the markets again. You know, we had that race up, and now we've got this race down, and it's back and forth. You know, we gain 3 or 4 cents in one day, and we lose 3 or 4 cents the next day. So I guess as you start looking at what we see happening right now, heading into this, you know, late July, August time frame where most weather models have called for very hot and very dry, going into key growing cycles for soybeans across the United States. And I guess as you take a look and see what's happening, what are your thoughts on the market and how the weather's shaping up?
Well, the market initially in late June, early July, got a little excited, as you know, and we got some movement higher. And then they convinced themselves that there's enough rainfall coming in, enough to take that risk, according to them, off the table. And so we've been like you said, we kind of took it back, and now we're just kind of in stabilization mode as the market tries to see what really is going to happen here as we move into the end of the month and into the first half of July. We're very confident about high heat continuing. I do think that it's a mixed bag with moisture. Some areas will get some will miss it. So it's kind of it's not a clear-cut picture. It's all dry. We continue to worry about the hot, warm nights for corn specifically, because that's really been a huge determiner for yields during pollination. And but that's where we're at. And then of course we're getting some buying from the Chinese pretty consistently now, but the market still is not willing to buy into that, because the little boy who cried wolf, they've heard this story before. They buy for a couple of weeks and then they walk away, and then we don't see them again for a while. So, but they are buying. So if that were to continue for a few more weeks, I do think the market would begin to maybe put in some Chinese buying premium, shall we call it. So where we are is, right now the market is sort of comfortable with the weather, but it's not comfortable to buy into this Chinese buying spree. And so we're just stuck in neutral, plus or minus 4 cents on the corn market, for example. That's kind of where we are right now.
Yep. Okay, so let's take a look at the Chinese and what they've been doing. They have made, really, for all intents and purposes, all the talking and let's be friends has pretty much broken down, right? It's kind of back to where it was January of 18. I mean, it's kind of in that same spot. They've asked the Chinese to close their consulate in Houston. They've done several things to basically just say we're not talking anymore, but the Chinese are still buying. That's got to be a pretty clear message that they aren't getting what they need anywhere else in the world but here. Fair statement?
Very fair statement. We've talked on this program many times, Casey, that the Chinese, for argument's sake, the phase one trade deal was more for show.
Right.
I've always felt, and we've always talked about on this program, that they will always buy what they need and what's economical to them. And right now they need grain from us, and right now it's extremely economical. The premiums of corn and soybean prices in China's domestic market are near historic high premiums to U.S. price. So they need it, and the price is right. And so they're not doing it to help us. They're not doing it to make Trump look good. They're doing it because it's good for the Chinese.
Right.
And so long as they have not satiated what they need, and so long as this price disparity continues, they're going to continue to be big buyers, and that's going to pump up the demand side expectations on everyone's spreadsheets and reduce the carryouts. That's what we think is going to start to happen here. And should Mother Nature get back on board with some concerns, then you can get something really going. But we do think at least the Chinese buying will prop up prices, we think, in August.
Yep. All right. So speaking of Mother Nature and kicking up some opportunity here, as you look at, you're in South Florida right now, and you're in that hurricane watch time of the year for you guys. All the weather models again have shown that this is going to be a very active hurricane season, and people are getting prepared for that. Hurricane seasons that are active usually wreak havoc on the cotton market. So I guess as you take a look at the cotton market right now and kind of throw this into the mix, what are your thoughts on cotton?
Well, already it's not going to be a hurricane. It doesn't look like. It looks like it'll be a tropical storm. But a tropical storm is supposed to just go right into Texas, or late weekend, early next week, and just throw tons of rain in there. And that's we're just getting started, Casey. So what happens is as we get further along and all the cotton opens up their bolls, that's when the moisture can really be nasty for reducing yield and quality. And so it's going to be a very, very active season, and we think that cotton market, the rice market, and the orange juice market are the three markets that are really going to be in the crosshairs for ongoing and maybe persistent and maybe multiple weather concerns as these storms come rolling in one after another that we think is going to happen this year. And right now, there's already 3 or 4 areas of interest that are forming that, so the season's, and by the way, in an active season, this really won't come down until mid-October. So we got a long 2.5 months of a lot of this going on that's going to be moving, especially those 3 markets. The other thing to look at, Casey, is this. A lot of times when these storms, they come into the Gulf and then they curve into the deep south and then they move away. A lot of times what that does is it draws moisture away from the Midwest and causes a high to form over the Midwest. So hurricanes have a lot to do with, we just talked about August weather, right? What makes August weather forecasting so difficult is exactly what these tracks are. But if a track comes in and moves away, it sucks all the moisture out. You can get this dome and hot and heat and dryness come in August. And that's something we're paying attention to see if we're going to get that kind of a storm that rolls in that deprives the Midwest of a lot of the moisture that the models are saying might come in. So it's going to be a pretty volatile 30 days, but we don't think the weather's going to be perfect. We think there's going to be some weather premium that's going to be put back into the markets now that the season is really started. I mean, we're starting to see the storms form now. We're just starting to get going now. So.
Okay. So with that being said, a hurricane season comes along and you start looking at stuff. There's going to be some opportunities also with the U.S. dollar where it's at, kind of hovering in that low 90s, mid 90s range. Export report comes out today, and what we see happening there, and there's some lofty goals compared to what we saw last year. I think a lot of that is triggered by what they think the Chinese are going to end up doing. But last year, this time, corn, they were looking between 400,000 and 1 million metric tons, and today they're looking somewhere between 1.5 to 3 million metric tons. So, same with soybeans. They're about 3 times as much soybeans, 1 million to 2 million metric tons versus 300,000, 700,000 this time last year. So, it feels like the USDA maybe has something up their sleeve there, and they're anticipating some buying that they're maybe not coming out yet. But I guess, what are your thoughts on just that, the export stuff? Not just necessarily the China side of it either, but let's look at what we see around the other parts of the world as well, especially when we start looking at areas that have been tormented by this desert locust. I mean, their things are just tearing stuff up. So talk about what you think is going to happen today with the export report.
Well, I mean, when we look at global corn supplies, Casey, we don't see a lot of corn. I mean, obviously the Chinese have a corn shortage right now. That's why they're buying so much. We know that there's really not a lot of corn anywhere. We have some corn here to sell, of course, but when we look around, the only place that really has a lot of corn to sell is the United States. And it's cheap, as you said. The dollar's been really kind of collapsing here lately. The last couple of weeks, I think it's down 5%, the lowest we've seen it in quite some time. Silver and gold have been surging here. In fact, silver has been gaining on gold. I mentioned in my report earlier in the week that we watched the gold to silver ratio, that in times of deflation, gold gains on silver, and in times of inflation, silver gains on gold. And so that relationship tends to move in 10 to 15-year cycles. So the deflationary cycle began in 2011. That's when gold began to gain on silver, and that ratio has been rising ever since, and it actually had a spike peak in March when we had that coronavirus scare. We actually broke out to an all-time high briefly in the month of March, and now the gold-silver ratio has been crashing as silver's been gaining dramatically. Silver prices have doubled, by the way, just the last 45 days. And so that tells me that we have just turned the corner and begun an extended inflationary period now after a long period of deflation. And so the weaker dollar is part of that. And exports improving in the U.S. is part of the inflationary cycle. It's part of the weak dollar cycle. And it's really important to have that tailwind behind us because it really helps with price and to move the product that we have right now to move. So I do think the USDA is starting to pick up on this concept that demand for U.S. grain and U.S. ag in general is improving, and they're starting to up their ante on their estimates accordingly, and we think they're correct in doing so. So I think it's finally turning into a bright spot after a long period of a headwind. We're going to start getting a tailwind from exports and currency, finally. So.
Yeah, it seems like it's shaping up that way. There's a lot more people coming to the table to buy U.S. products than we've seen in a while.
Copper, for example, is almost $3 a pound. That's up almost 40% in just the last few months. And usually, now what's been happening is copper been gaining on gold. So when copper gains on gold, that means the market is also assuming more inflation, but also assuming an increase in infrastructure spending in that part of the economy. So that usually is an early sign of better. The precious metals and the metals in general tend to go first, and then the ag markets kind of follow behind it. So we're really encouraged that some of these markets that tend to be the first movers are really taking off the cycle. And so it's early. Doesn't mean the grains have to move today or tomorrow, but it's a good early sign that we're starting to finally shift this asset class and start going to attract. We might be attracting some money away from stocks and away from real estate, and for the first time in quite a while. Because as you know, commodities have been the poster child for where you should not put your money for a long time. So. Yep.
All right, let's talk about oil for a little while. We had that amazing drop off there where oil was they're paying you to take it, and then it's kind of bounced back nicely. But there's been some pretty good volatility in the oil market here of late. Talk about the oil market, what you see happening there, and it kind of feels like Russia and Saudi Arabia or OPEC anyway, have decided that they're going to let bygones be bygones and kind of work together as much as they possibly can to make the oil market bounce back. But it's not bouncing back. You kind of hit that point, and it's not really. You've hit some really big volatile points in the middle. So I guess talk about what you see happening in oil.
Well, we talked about that. That you could only keep oil, as low as it was for only. We talked about maybe the fall, maybe the maximum they could keep more prices down because economically, no one can survive with $20 or $10 or $0 oil.
Right. Yeah.
So obviously, the Russians' economy is in tatters. Their main economic drivers crude oil, and so they have a vested interest in making the price go higher. And so that game is on, but we have gotten to a point where that initial surge off the lows has taken place, and the market is trying to determine what is the new normal demand for crude oil. Meaning, all right, the U.S. is sort of reopened, and Europe is sort of reopened, and China is sort of reopened. Yet we're having some secondary infections and partial closures, but not all. The market's just trying to figure out what is actually going to be a run rate now, given what we see in the virus right now. And so I think that's prevented the oil market from going much higher. But I also believe that, as you said, Russia and Saudi Arabia have gotten together and said, look, let's be friends and let's prevent it from going down. But I think it's found a happy home right now until we get a little further along to see, what's going to happen here. There's a lot of fear right now that as we get back into the flu season here in the fall and the winter, that things could get, worse. And so whether that's true or not, I just think that fear right now is holding the crude oil market back for a little while. And so I expect a sideways choppy trade until that can kind of get resolved here a little bit.
Yeah, so in the U.S. you can't have that conversation of oil without throwing ethanol into the mix. So ethanol demand has come up. More and more plants have come back online. We're starting to see even China is doing some exporting of refined ethanol. We're starting to see that a little bit, which is a game changer when it comes to ethanol if that actually continues to be a trend line. So when you look at ethanol, what are your thoughts there?
Well, think of it this way. Why are the Chinese buying corn? Because they don't have any. What are they primarily using in their own country to make ethanol? Corn. Why are they, so they need corn for ethanol. They need corn. They're rebuilding their hog herd. They need corn for feed. They're going to need to buy U.S. ethanol. We have excess capacity, Casey. They do not. So they know, we're really good at it. We've been doing it for a long time, and we're able, willing, and ready to make them, a lot of gallons of ethanol if they want it. And so I think they're going to buy a lot. Not only are they going to buy corn, which they did, but they're also, it's going to be a two-pronged approach. They're going to buy ethanol. So not only do we get demand for better exports, but we get better demand from the ethanol guys getting a better price than demanding more corn from domestic farmers to bid up the bases, cash bases, and bring more corn in, which is always a win-win. Price goes up, basis goes up. So we're pretty optimistic that two-pronged approach is going to be with us well into the end of the year. And remember, these historic floods that they've been dealing with down there in China, really you have to go back to 1931, the last time we saw that any kind of flooding of this magnitude, decimating the rice crop, decimating the canola crop, half the soybean crops underwater. I mean, they have some serious problems with their food supply. And so I think that is also getting them even more interested in buying cheap grain and cheap food from us while they still can. So all that being said, we're pretty bullish on corn and ethanol into the end of the year, and think that prices are going to work their way higher, as I've already started to. Ethanol is well off the lows already. So.
Yeah. All right. Last thing, let's talk about the protein markets real quick. The pork market has had a pretty good run here last couple of weeks. There's some volatility in there, but for the most part, they've been finishing higher more days than they haven't. And what are your thoughts there? I mean, are we looking at? I mean, obviously, China is still buying a lot of pork, but have we gotten rid of the glut a little bit now, and we're looking more of the supply and demand curve starting to kind of pan out with each other?
We believe the month of August is the inflection point for hogs, Casey. We think that's the point where this overhang, these excess of animals that have not been able to be processed, starts to reverse, and we actually start getting more demand for the animals than the animals that are available. That's a combination of two things. It's a combination of all the euthanizations that took place during the pandemic panic, and secondly, because of the extremely poor prices, the farrowings in the summer and the fall are going to drop at the largest rate in 25 years. So when you put those two things together, the number of animals available to bring through packing houses is not going to be sufficient to meet the demand that continues to, by the way, to be very, very strong. So we're pretty excited about the hog market heading into the fourth quarter. We think we're finally going to get a surge there, like cattle's already gotten, as that supply-demand kind of balances out. And so we do think if you're in the business of buying hogs, cash hogs, and you're in the business of buying pork, we think that one should be looking to protect upside price risks at this point. We don't think one should be living hand to mouth. We think this could be a pretty exciting repricing higher of the whole hog complex as a result. So pork cut out, for example, yesterday surged. You're starting to see all these signs are coming to place that we're tightening up this market finally.
Cool.
So.
All right, let's bounce over, take a look at the cattle market. Their stocks they kind of reported they're starting to rise in June, and we're starting to see some more stocks out there. So the number of animals getting through slaughter is pretty much back to normal. I think it might be off just a little bit from where it was this time last year, but it's nothing like it was 5 months ago. So we've made some pretty good strides there, yet the market has not really responded to what we're seeing there. So I guess talk about what you see happen in the cattle market and kind of some of the stuff you see ahead there.
Well, remember, the difference between hogs and cattle is the hogs, they didn't back up the animals, they killed them off.
Right.
And because the cycle in hogs is so short, you say, okay, I don't like the price, I'm just, we're going to just, not reproducing. Cattle's a little different, you just don't do that. The animals got backed up. They put them out, they increased their weights, but the animals didn't go anywhere. They're still there, and they're backed up. So even though the throughput So think of it this way, Casey. You have a tub of water, right? And you have a drain that was draining at a certain rate. And then you cut that rate in half. And then you open it up again. You just can't make up what you lost. It takes time. And so because of the increased weights and because of the backing of the animals, there's an overhang of supply there that it's going to be difficult for demand to overcome that for a while. It's not bearish, meaning like I don't think the prices are going to fall a lot. I just think I think we're just in a two-sided trade here for a while because the market's probably at the right place and supply demand is probably, we think, in balance right now. And I think it's going to stay that way for a while. We're not really thinking, a big surge is ahead of us right now for cattle. We think the hog market's more in a better place to see that. So we would be pretty much, kind of agnostic right now, neutral on the cattle market at this point. Just looking for opportunities to sell or buy based upon, kind of a trading range that we expect to develop here if you're on a cash seller or a cash buyer. So
okay, milk is the other thing that we've needed. I've ignored here for a little while, but it has had the best rebound since we've looked at what we've seen happen so far since the COVID-19 shutdown. There for a minute, milk was atrocious, and then slowly after they opened stuff back up, we saw pre-COVID numbers start coming back into trade. So talk about milk, what you see happening there, and what the stability looks like for Class 3 milk.
Well, look, Class 3 prices, which is essentially cheese, but primarily drives Class 3, had a big rebound because we are reopened and demand came back, and there was always strong demand at the supermarket level. But on top of it, the government decided to do a bailout program where they bought a bunch of cheese, 5% of the market actually. Over every month they were going to be buying 5% of the cheese market. And they've been doing that. So not only did you have the increase in demand from reopening, that you had this demand from the government. So it's sort of an artificial price level. So they've run the Class 3 market up as high as 23 and change, and we were down at 12 and 13 back there in April. So you just think of how much of a move that is. Now Class 4 prices, which is more of the milk powder, butter kind of a thing, they have not been buying those, and they're sitting around more like the 15 area, 16 area, which is really where Class 3 probably should never have, maybe Class 3 could have gotten 17 on its own. So what we're worried about, Casey, is that as we approach the elections, the government's going to walk away and say, we're done, we did what we needed to do, we helped you guys out, you're on your own. And if we take that artificial buying out of the market, the Class 3 price could really have some difficult times heading into the fourth quarter and certainly after the election. So we're really feeling that producers ought to be taking advantage of the price that they're seeing right now, at least on Class 3, not Class 4. But on Class 3, it's an awful good price, and it's an artificial price. We have to remember the government got its hands involved and created an artificial market. So don't look a gift horse in the mouth for too long, or else you'll go. So we think most of the upside, if not all the upside, has already been seen, and we would not want a dairy producer to throw caution to the wind and not take advantage of those prices. We think they need to be, taking advantage of that before it goes away. And now the Class 4 market, we're actually more optimistic. So what's been happening is we had this record spread between Class 3 and Class 4 because of government intervention. But when the government walks away and the Chinese typically buy their year-end powder, we think that we're going to actually flip this ratio opposite. Where Class 4 is going to rise, Class 3 is going to fall. We're going to get a premium of Class 4 to Class 3. So it's kind of a bifurcated market. It's not bearish everything. It's bearish Class 3, bullish Class 4. So we're really saying, wait for the upside on Class 4, do some pricing on Class 3. So,
right on. Well, Shawn, good stuff as usual. Folks want to reach out to you and ask you questions about what you have going on, or just pick your brain about some of your reports that you're putting out. What's the best way to get your report and also see what you have to offer?
Our website is Hackett, Hackett, advisors.com. They can look at sample reports, interviews, podcasts, all kinds of things that we have on the white papers we've written to see if what we do might be of value to your listeners.
Right on. Well, I'm Casey Seymour with Moving Iron Podcast. Make sure you check me out on Facebook, Twitter, and Instagram. That's where you can find the latest podcasts when they come out, as well as any blogs I have to post. Also, check out the Global Ag Network and the great podcasters there. And go to movingironllc.com for the latest news on everything that has to do with moving iron. So I guess with that, I'm Casey Seymour with Shawn Hackett. Let's go move some iron, folks. Out.
Moving iron in the 21st century. Hard-working people working hard for you and me. Moving iron time and time again. Through the years you'll find us here.